March 2022. Credit score 511. Couldn't get approved for an apartment. Got denied for a car loan. Applied for a secured credit card, the kind designed for people with terrible credit, and got rejected for that too. 90 days later. Credit score 631, then 658. By day 90, it hit 641, a clean 130-point jump, enough to get approved for an apartment, a card with a real credit limit, and a car loan at a rate that didn't feel like robbery. No credit repair company, no pay-for-delete scams, no bankruptcy, no magic, just a specific sequence of moves, executed in the right order at the right time. This video shows you exactly what those moves were. My name is Bobby, and I spend way too much time thinking about how the credit industry has convinced Americans that a bad score is a life sentence, when the actual mechanics of how scores are calculated can be used to engineer a rapid, legitimate recovery in under 90 days. If your score is hurting you right now and you want the real playbook, subscribe and let's get into it. Here's the thing. We've been sold this story that fixing credit takes years, that you just have to wait it out, pay your bills on time, be patient, and slowly, painfully slowly, the score climbs on its own. 7 years for a bankruptcy? 7 years for a collection? Just sit there and suffer, and eventually time heals everything. That's not wrong, but it's massively incomplete. What the credit industry doesn't tell you, what the banks and the bureaus have zero incentive to explain, is that your credit score isn't a permanent record of your financial past. It's a live calculation, a formula. And like any formula, if you understand the inputs, you can move the outputs fast. FICO, the company behind the score that 90% of lenders use, publishes exactly what goes into your number. It's not a secret, it's right there on their website. 5 categories, 5 inputs, each weighted differently. And 2 of those 5 inputs, which together account for 65% of your total score, can be meaningfully moved in under 30 days. If you know what you're doing. The credit repair industry exists because most people don't know this. They charge you $99 a month to do things you can legally do yourself, for free, in an afternoon. The banks benefit from you having a low score because it justifies higher interest rates. The bureaus benefit from selling you credit monitoring subscriptions to watch a number they have every incentive to keep confusing. Nobody in this system gets paid to explain how it actually works. That ends today. Let me take you back to 1989 for a second, because understanding how the credit score was invented is crucial to understanding how to game it. Before 1989, lending decisions were made by individual loan officers using their own judgment. There was no universal score, no standardized number. You walked into a bank, a human looked at your file, and decided whether you were creditworthy. The system was inconsistent, discriminatory, and slow. Then Fair, Isaac, and Company FICO introduced the modern credit scoring model. The idea was elegant. Reduce the complexity of creditworthiness into a single 3-digit number that any lender could use to make instant, standardized decisions. A score between 300 and 850. The higher the number, the lower your risk. Banks loved it. It made lending faster, cheaper, and more scalable. By the mid-1990s, Fannie Mae and Freddie Mac required FICO scores for all mortgage applications. The score became the gatekeeper to the American financial system. Here's what nobody questioned. The formula FICO built was designed to predict the probability that a borrower would go 90 days past due within the next 24 months. That's it. That's all it measures. It's not measuring your financial health. It's not measuring your net worth. It's not measuring your character or your discipline or your potential. It's measuring one thing: statistical likelihood of missing a payment. And that matters enormously, because a formula built around that specific prediction has specific vulnerabilities, specific inputs that move the number dramatically and quickly that have nothing to do with how financially responsible you actually are. Understanding those vulnerabilities is the entire game. Let me walk you through the 5 inputs, because this is where everything changes. Payment history is 35% of your score. Whether you pay on time, this is the biggest single factor. 130. Day late payment can drop a good score by 60 to 110 points. This is also the slowest factor to repair. You cannot delete legitimate late payments except through time or specific dispute strategies. Credit utilization is 30% of your score. This is the ratio of your current credit card balances to your total credit limits. If you have a $10,000 credit limit and you're carrying $7,000 in balances, your utilization is 70%. That's destroying your score. The target is below 10%, not 30% like most people say, below 10% for maximum score impact. Here's what nobody tells you about utilization. It resets every single month when your statement closes. If you pay down your balances today, within 30 to 45 days, as soon as the updated balance reports to the bureaus, your score reflects that improvement. This is the fastest lever in the entire system. Length of credit history is 15% of your score. How long your accounts have been open, average age of your accounts. This is the slow-moving piece. You cannot manufacture history, but you can stop destroying it, which most people are doing without realizing it. Credit mix is 10% of your score. Having both installment loans and revolving credit, lenders want to see that you can manage different types of debt. This is the least impactful factor and the most misunderstood. New credit inquiries are 10% of your score. Every time you apply for credit, a hard inquiry hits your report. One inquiry drops your score 5 to 10 points. Multiple inquiries in a short window signal desperation to lenders. Now here's where this gets real. Utilization 30% of your score resets monthly. Payment history 35% of your score can be disputed if there are errors. Those two categories alone are 65% of everything, and both can be moved meaningfully within 30 to 90 days. That's the window. That's the opening. That's how 120 points in 90 days is mathematically possible. So why doesn't everyone know this? Why are people sitting on 520 scores for years when the levers are this accessible? Because the credit system is specifically designed to feel overwhelming, opaque, and permanent. And several industries profit directly from that confusion. Credit repair companies are a $4 billion industry in the United States. They charge monthly fees ranging from $79 to $149 to fix your credit. What they actually do, the only legal things they can do is dispute errors on your credit report and send goodwill letters to creditors, both of which you can do yourself for free in an afternoon, using letters you can find on the Consumer Financial Protection Bureau website. The bureaus themselves, Equifax, Experian, TransUnion, sell credit monitoring subscriptions at $20 to $30 a month. They have a financial incentive to keep your score confusing enough that you feel like you need their help interpreting it. They also sell your data to lenders, who then offer you products at rates calibrated to your score. The lower your score, the higher the rate, the more the lender profits. And here's the trap that really locks people in. When your score is low, your borrowing costs are higher. Higher costs mean more of your payment goes to interest instead of principal. More interest means slower debt paydown. Slower paydown means utilization stays high. High utilization keeps the score low. It's a loop, a deliberately frictionless loop that keeps people paying maximum interest rates for maximum time while feeling like there's nothing they can do about it. The only way out is understanding that the loop has an entry point, and once you find it, the whole thing unravels fast. Here's the exact sequence. 30 days at a time, in this specific order. Days 1 through 30, dispute and clean. Pull all 3 credit reports for free at annualcreditreport.com. Not Credit Karma, not Experian's own site. The federally mandated free reports at annualcreditreport.com. Go through every single account. You're looking for 4 things. Accounts that aren't yours, identity errors are more common than you think. Late payments that are incorrectly reported, a payment marked 30 days late that was actually on time. Balances that don't match your records. Collection accounts where the amount is inflated or the date is wrong. Federal law under the Fair Credit Reporting Act requires bureaus to investigate disputes within 30 days. If they cannot verify the item, meaning the creditor doesn't respond, it must be deleted. Deleted items improve your score immediately. Studies from the Federal Trade Commission found that 1 in 5 Americans has a verified error on at least one credit report. 1 in 5. You may be sitting on a dispute that removes a collection, a late payment, or an entire account that was never yours. That single dispute, if successful, can move your score 30 to 60 points by itself. File disputes in writing. Certified mail. Keep copies of everything. Don't use the online dispute portals. They route through automated systems that are easier for creditors to defeat. Days 31 through 60. Attack utilization. While your disputes are processing, turn everything toward utilization. This is where the heavy lifting happens. List every credit card you have, current balance, current limit, current utilization percentage. Rank them from highest utilization to lowest. Your goal is to get every card below 30% utilization and ideally below 10% on your highest limit cards. The scoring formula looks at utilization both per card and across all cards combined. One card at 90% utilization is hurting you even if your overall utilization looks okay. If you have cash available, pay down the highest utilization cards first. If you don't have cash, look at two strategies. First, call your existing creditors and request a credit limit increase. You've been a customer. Ask. If they approve even a $500 increase on a $1,000 card, your utilization on that card just drops significantly without paying $1. Second, if you have a trusted family member with a credit card and low utilization and good payment history, ask them to add you as an authorized user. Their card's history and limit reports to your credit file. You don't need to touch the card, you just inherit the benefit. This alone can add 20 to 40 points within one reporting cycle. Days 61 through 90, build and lock. By day 60, if the disputes worked and utilization dropped, your score has moved. Now you lock it in and push it higher. Open one secured credit card if you don't already have revolving credit in good standing. Not a prepaid card, a secured card that reports to all three bureaus. Deposit $200. Charge one small recurring expense to it, a Netflix subscription, a tank of gas. Pay it in full every month before the statement closes. This establishes on-time payment history, adds a new positive account, and keeps utilization near zero. Set every existing account to autopay for the minimum payment. Not because you're going to pay only the minimum, but because you are eliminating the single greatest score risk. An accidental late payment that wipes out 90 days of progress in one shot. Do not apply for anything new during this 90-day window. No new credit cards, no financing offers, no check your rate applications that trigger hard inquiries. Every hard inquiry costs you points. You're building, not borrowing. By day 90, if you've executed this correctly, cleaned the report, attacked utilization, established positive history, you are looking at a 80 to 130 point improvement. Not a guarantee. Not every situation is identical, but the math is on your side.